Q&A, because when I've been to, and this is like the 10th one that we've done, every day there's a panel, there's a webinar, and I really do believe that this is going to be as big as it all sounds. So, the Opportunity Zone was part of the Tax Cut and Jobs Act in last year. And I certainly didn't read the tax plan, but this, tucked in that was 6 pages on this Opportunity Zone. And you heard people start to talk about it earlier this year when they started designating areas. So it is a federal program, and it allows each of the states to designate up to 25% of their census tracts as Opportunity Zones. Okay, so for New York City, it's a large portion of the boroughs. Actually, there are some pockets here in Manhattan as well. But we did a study, and we found that 90,000 properties in New York City sit within the Opportunity Zone. So that is a lot of opportunity, no pun intended. Now that being said, and I'll tell you a little bit about the program, it works best for land projects that require substantial improvement. So, with that in mind, it doesn't really work for rent-regulated housing. It's really good for land for vacant properties. So, the way this works, and we're going to be talking about the differences with the 1031 exchange, and I think a lot of you, savvy real estate investors might still say, James, I like this 1031. I like continuing to just roll my gains and keep selling and keep buying property and deferring those gains. And you may, after this morning, elect to continue to do that or do both. But I think what's so exciting about this program is it opens up the real estate industry to a whole new audience of investors. Because, as Pamela will tell you, the 1031 is for like-kind exchanges. That's, you sell a piece of real estate, you buy real estate, okay? In its most simple terms. The beauty of the Opportunity Zone is it's for any kind of capital gain, right? So think about someone who sells $10 million of Facebook stock. Think about the entrepreneur who just sold their company for $800 million. Think of the family offices. I have heard estimates that there is somewhere between $2 to $6 trillion of capital gains embedded in the market. Now, a lot of that's what props up our stock market, so I hope everyone doesn't go run to their wealth manager today and sell off everything they have. But there is quite a bit of this embedded gain, and I do believe that because investors don't like to pay taxes, they've been holding on to those significant gains. So this is how the program works. So if you have a capital gain in 2018, so you must have sold, again, property, stock, art, your company, okay? That had to happen in 2018, not, you did this last year. You have that gain. You have 180 days to reinvest it into an opportunity fund, okay? That fund exists for the purposes of investing up to 90% of its assets in Opportunity Zone projects, okay? So for a lot of you, and you start reading in the papers, RXR is opening up a $500 million fund, and crowdfunding, you have all these funds. Let me just warn you all first, and look, RXR, I'm sure they know what they're doing. They own the property. I feel, pretty good about what they're doing. But unfortunately, this is going to be something where I think a lot of investors are going to get tripped up because the timing is very tight on this. If you have 180 days to reinvest, right, and then you're going to learn that you have to go substantially improve that property. They give you 30 months, after closing on that property, really after maybe, and again, you'll learn that part of this is still open to a lot of interpretation. I found it interesting that the original provision in the tax plan was 6 pages and the clarification was 72. So go figure, and there's still a lot to answer, but again, the timing is you have 180 days to make that investment in that property, right? And then you're going to have 30 months thereafter to make improvements. So again, the challenge is if you're investing in a fund and how are they going to pull all that investment together in that 180-day period? how are they going to do capital calls so everyone's on the same schedule? I think we're going to see a lot of individual investors like yourselves who are going to, pick a project and invest your gains in it. So the benefit is you do get a deferral of those capital gains. So if you make that investment before the end of next year, you get the full 7 years deferral. You will have to pay the capital gains tax on that original investment in 2026, but you receive a 15% discount then on the capital gains tax due. So think about that. So you have a $10 million gain, right? Just sold your Facebook stock. Let's say, for sake of argument, you would have paid 25% in capital gains tax, okay? So you got a $2.5 million tax bill. Typically, if you sold that stock on the open market, you pay your tax that year. So now that $2.5 million tax bill is deferred for up to 7 years, okay? 2026, you have to pay that tax. You're going to get a 15% discount on that $2.5 million of tax that's due, okay? So there is some benefit. Again, for those of you who are used to 1031, you're saying, I don't like paying taxes. The 15% discount's nice, but I'm going to have to sit there and I'm going to have to pay the tax. But the incredible part about this program is if you hold the investment for 10 years, then you get a stepped-up basis. So that $10 million investment I made, now I go sell the property for $20 million 10 years from now. That $10 million of profit is tax-free. And that's, I've been doing this 20 years. I've never seen anything like this where you can actually make a profit completely free of tax. So that is really, the biggest differences between the 1031, the Opportunity Zone. One is who this is available to, so capital gains from any sale. So what this is going to do is bring in a whole new wave of investors who are looking at these projects, and then you'll get that stepped up basis, and you will have the ability to get profit tax-free, okay? So what are you supposed to do with these properties? And I've spent a lot of time talking to some of you in the room about what this is going to do for the community and for the areas. This is a great, the more I look at this program, I'm trying to poke holes in it, but this is going to do a tremendous amount of good, right? Because we're going to target a lot of investment now, again, predominantly in the boroughs. And the way this works is there's two ways to qualify for the Opportunity Zone. One is called a substantial improvement, okay? So what they're going to do, I gave you that example. We had our $10 million gain, okay? So what's going to happen is, let's say that we buy the property for $6 million, okay? And just to make it simple, no debt, okay? What they're going to do is they're going to, and I was talking to an appraiser earlier, I said, you're going to be very busy over the next year or two, because what they're going to do is you're going to attribute the value of the land and the building. So I just bought a vacant building on a piece of land for $6 million. Again, just for sake of argument, we're going to value the land at $1 million, the building at $5 million. We have to spend at least $5 million to renovate it, okay? So you have to spend the same amount improving the building as you did purchasing the property, okay? That's substantial improvement, okay? And you can use your gains to do that. Use your gains to purchase the property. You're sitting there in the Opportunity Fund. You've made your purchase. You've got your plan. And by the way, this is, unfortunately, I think a lot of people are going to get into some challenges here, because this is all self-certified. So this is literally checking a box on your tax form. So before you all try to go out and do this, please, please, please get accounting advice and legal advice, because do not want to see you all get tripped up in the details. But yes, you can self-certify you're doing this. You've got your 30 months to make improvements. You hold it for the 10-year period. You get the stepped-up basis. The other way to do this is called first use, okay? So this really only applies to land. If you go build a building, it was never there before. So if you open up the property, you have qualified for first use. Then you do not have to do the substantial improvement where you spend the same amount renovating as the value of the building, okay? So what we think is going to happen is a lot of the developers in the room, you all might say, well, James, I'm already, 70% into construction. I'm already doing a project in the Opportunity Zone. How do I qualify? What do I do? Well, unfortunately, this investment has to have happened in 2018. So if you already own the property for 10 years, unfortunately, it's very difficult to participate in this. But if you're building the project, and again, please get legal advice because I'll get myself in a lot of trouble, is that if you are, call it 95, 98% complete, you can sell that project to an Opportunity Zone fund with your paperwork and your C of O all ready to be filed, hand it to them. They put the building in service. Okay, now they have introduced this building, this first use, and do the lease up, and that qualifies for an Opportunity Fund. So I'm going to stop there because it's a lot of information. Any questions on how this all works? Yes?
So I have exactly that scenario, right? So I'm in the Lower East Side, right off of Houston, obviously a distressed area that qualifies for the Opportunity Zone. I'm at bought the land in 17, about 30% constructed, got a frame up. I've been having a lot of blowback from accountants and lawyers who just sometimes making up stuff. You said it with fairly good confidence that if it's an original use, even if there's an existing structure, it's not a legal building, we don't have a CO, that the new buyer can put it into service and get the benefit. Is there a smarter person you're talking to?
This came, I will go ahead, I'll give you his name and phone number, but yes, we did a panel yesterday with Eric Feinstein, and we checked this out with Louis talking, but I will say I've spoken to developers who are building millions of square feet under this assumption.
Awesome.
But you're right, I mean, again, they're trying to interpret the original 6 pages and the 72 pages, and they're saying, look, who actually puts the building into service? What is the first use? The building is not really open for business, right, until you you get the C of O and you tenant it. So, but again, you're going to see a lot of audits, and you might say, look, I want to play this safe, and maybe this is a little too risky to do. I will have one thing that is really interesting about this. It's not just for real estate investment, it's for operating companies as well. So think of buying a company buying a vacant industrial building and doing the renovations, buying the equipment, the conveyor belts, the forklifts, all that qualifies as well. In fact, I'm even talking to some friends who are saying, look, I'm on my 5th startup. I want to take my capital gains from selling my last company, and I want to go open up my business in Harlem. And when I sell my company in 10 years, I'm going to get my profit on the company sale. Now, again, the requirement is that 90% of the business has to be done in that Opportunity Zone, so that's a little tough, if you're doing a tech company where your audience is worldwide. But I think this will be a good thing for, certainly for the boroughs, because you're going to see a lot of companies who are going to want to open up there. I also think that there's a big case to be made for investing in the boroughs opposed to elsewhere in the U.S. So yes, this is a federal program. I said yesterday that yes, you could do this in Kentucky, but the question is, where do you all believe is going to have the greatest appreciation in 10 years? Of course, we're all New Yorkers here, so we'll say New York, but the stats behind that is the average building in Manhattan sells for $1,000 a foot. The average in Brooklyn is $600 a foot. Queens, $500, and the Bronx are $200 a foot. Actually, after this morning's official news on Amazon, Queens might have just made a jump there, so you better act fast. But the point is, would you say that Bronx office rents on average are 1/5 of Manhattan rents? I mean, I think what you're seeing is a huge disconnect in value where you can go, 5-10 miles north here and values drop off to, 1/4, 1/5 of what they are here. So that doesn't make a lot of sense to me, and if I had to bet, I would say in 10 years you're going to see that gap close. Any other questions on the Opportunity Zones and how these work? Yes, Dave?
Would you clarify, is this program only available during 2018?
Thank you for asking that question. So if you want the full benefit to defer the gains 7 years and get a 15% discount, you have to make that investment before the end of next year. Okay? Now, I kind of skipped over some of the in-between steps because I assume anyone who's going to do this is going to do this to hold for 10 years because that's the whole point of it. But if you were to sell within 5 years, if you make the 5-year mark, you get a 10% discount in your capital gains. So the point is, if you want to get the benefit of that 15% discount, the taxes have to be paid no later than 2026. So that's why you have to make your investment by the end of next year. But look, this program is open until 2048. So, you could do this in 5-6 years and buy a project, but then you're not going to get the benefit of the deferral because everyone's got to pay tax in 2026. And you might not be eligible for that 15%, but you still get the benefit of the 10-year step up in basis. Yes?
So if everyone has to pay a tax in 2026 and you're fully invested in your qualified fund, where does the cash?
Great question. Great question. So I believe that what most people are going to do is buy these assets all equity, and again, you're going to have your purchase, you're going to do your improvements out of your capital gain, and then by 2026 put some debt on it. So the debt does not, let's say in my example, your capital gain is $10 million and you put debt right off the bat and go buy a $30 million property. For sake of argument, let's say the building's worth $25 million, the land's worth $5 million. Now for substantial improvement, you have to go spend $25 million. So you just made your bar that much higher to do that investment. So I think maybe the conservative way to do it is to take the entire capital gain, reinvest that, and then when it's time to pay the piper, then put some debt on the property to finance it. Yes?
I'm a little confused. The 15% reduction and the 7-year deferral or potential for the elimination of capital gains tax, that is for the capital gain on the property sold comes with the cash to make the investment in the opportunity zone. In other words, your example you gave earlier, I sell Amazon stock, I have a gain of $10 million, then I invest in the opportunity zone. The deferral is on that $10 million.
Correct.
Okay.
Correct.
So what? Then,
so the deferral is on the tax that's due. So again, in that example I gave, you have a $10 million capital gain, which you otherwise would have had to pay, let's say 25%. You would have had to pay $2.5 million in tax this year. That $2.5 million you can defer up until 2026, and if you do that before the end of next year, you're going to get a 15% discount on the $2.5 million that's due. Okay? Then, after 10 years, you get a stepped-up basis. Your basis is $10 million.
I'm sorry, stepped-up basis in
the new project, correct, that you just did. So you just built a property, all in for $10 million. You go sell it in 10 years for $20 million. You're getting $10 million of profit tax
so
free.
Potentially, if you hold it for 10 years, you've got two benefits: the deferral and reduction on the capital gain.
The original, yep.
The original disposition, and then a stepped-up basis.
That's correct. Correct. Yep. Yes.
Is there a minimum capital gain or?
No. It's available. I was speaking to one family office and they said they have $500 million of gains. I mean, one of the stats slides that I shared yesterday is last year in all of the United States there was $577 billion of sales. That's across all property types. And even if you said, okay, well 25% of these areas are in opportunity zones, we know those opportunity zones, the properties are not selling for as much as the rest. Well, let's just say that maybe there's $100 billion worth of this property out there. I mean, if there is really $2 to $6 trillion of capital gains, there's going to be so much new money chasing these. And, we're having discussions. I spoke to a developer who does luxury condos in Manhattan. He said, I'm only looking for projects now in the opportunity zone. So people ask me, well, James, what is this going to do? I own property. What's it, in an opportunity zone? What does it do to the value? Well, I think there is that tax benefit where people are going to be saying, well, I'm going to net present value the fact that I'm saving 15% off my capital gains and deferring that for 7 years. And if I think I'm getting a $10 million profit and I'm down the road and I'm saving those taxes, what's that worth in today's dollars? That's one way to do it, but I think the other way is to compare it to, it's really supply and demand. You've got investors now who would never maybe consider these areas or these kind of projects, and they're now saying we want to do this. So for those of you who are out there raising capital, you're going to have this, this whole new audience of investors saying, I want to invest with you. And typically maybe you'd say, hey, we're going to do a 3 to 5 year project. I'm going to get you a 15% return. And now they're going to say, well, okay, so you're going to build to a 5.5%, 6% return, and I got to hold it for 10 years. Well, I'm willing to do that because this is the way I'm going to set up a generational wealth transfer. Yes?
Does that investment have to get made by the end of 2030?
I just answered that earlier. The program is open up until, I think, 2048. You would just miss the opportunity to do that deferral, but you'd still have the step-up opportunity. Yes?
So any limit to the step up on the basis, or how long you can hold it? You can hold it probably 30 years.
I think they say that the opportunity zone actually ends in 2048. So in 2048, the opportunity zones will disappear from the map, but I believe the clarification, please check, says that you could still make your sale, get that stepped up basis, and the profit free after that. So what we'll do, we wrote an article on it. I'll send the map so you all can see where these opportunity zones exist. A couple memos that are out there. There's a lot of them out there, and as Mr. was saying earlier, you get a lot of opinions. So so sometimes there's still going to be case studies, things open for interpretation. So, but with that, I'm going to bring up Pamela. She's going to talk. Is that you going next or? Oh, Ed? All right, you okay.